Right now, somewhere in Australia, someone is about to lodge their tax return without realizing they could legally reduce what they owe by using a strategy that has been sitting inside the tax rules for years. It is not a loophole. It is not a trick. It is a completely legal carry-forward rule most Australians have never heard of, and even fewer have ever used. Every year this strategy goes unused. People miss out on a real opportunity to reduce their tax and grow their superannuation at the same time. And once the financial year closes, that opportunity for that year is gone for good. Stay with me, because by the end of this video, you will know exactly what this strategy is, how it works, and whether it could apply to you. Here is how most Australians approach their super and their tax every single year. They work. They pay tax. Their employer puts the compulsory amount into super, and that is where it stops. Most people never make an extra contribution, not because they do not want to. Often it is because life gets busy, money feels tight some years, and topping up super never quite makes it to the top of the list. What most people do not realize is that the Australian tax system actually rewards you for catching up later. If you did not contribute as much as you were allowed to in previous years, the unused space does not just disappear. In many cases, it can be carried forward and used in a future year. This is one of the most underused parts of the entire superannuation system. So, what is this strategy exactly? It is called the Carry Forward Concessional Contributions Rule. Let me explain it simply. Every financial year, there is a cap on how much you can contribute to super as a concessional contribution and claim a tax deduction for. For most people, that cap is $30,000 per year, including what your employer already puts in. If you do not use the full amount in a given year, and your total superannuation balance is below $500,000, the unused portion can be carried forward for up to 5 financial years. That means if you have been under the cap for the last few years, you may have tens of thousands of dollars of unused contribution space sitting there right now, ready to be used in a single financial year. This is especially powerful if you have a year where your income is higher than usual, because a bigger contribution means a bigger potential tax deduction. Let me walk you through a simple example using easy numbers. Imagine your employer has been contributing $8,000 a year into your super for the last 4 years. The cap each year was $30,000. That means you left $22,000 of unused space on the table every single year. Over 4 years, that adds up to $88,000 of unused contribution space sitting there, available to be carried forward. Now imagine this year, you receive a bonus, sell an asset, or simply have extra savings sitting in a low-interest bank account. You decide to make a personal contribution of $40,000 into your super and claim it as a tax deduction using some of that unused space from previous years. Your taxable income for the year could drop significantly. Depending on your tax bracket, that could mean thousands of dollars less tax owed, while at the same time adding a meaningful amount to your retirement savings. These figures are simplified for illustration only. Your actual outcome depends on your income, your super balance, and your personal circumstances. So who might this actually help? People who took time out of the workforce. If you had a career break to raise children, care for a family member, or recover from illness, there is a strong chance you have years of unused contribution space waiting for you. Self-employed Australians, if your income fluctuates from year to year, this strategy lets you contribute more in strong years and make up for lighter years. People who had a higher income this financial year, a bonus, the sale of an investment, or extra work can create a bigger tax bill, and a bigger contribution this year could help offset that. People with a total super balance under $500,000. This is essential. If your balance is above that threshold, the carry forward rule does not apply to you. and people approaching their 50s or 60s who want to boost their retirement balance while they still have a reasonable number of working years left. This is where people often get it wrong, so listen carefully. Mistake number 1. Assuming the unused cap lasts forever. It does not. Unused concessional contribution amounts can only be carried forward for 5 financial years. After that, they expire and disappear completely. Mistake number 2. Forgetting to check your total super balance. The carry forward rule only applies if your total super balance was under $500,000 at the 30th of June of the previous financial year. If you are close to that number, check carefully before assuming you are eligible. Mistake number 3. Missing the notice of intent form. Just like a regular personal concessional contribution, you must submit a notice of intent to claim a deduction to your super fund before you lodge your tax return. Without this form, you cannot claim the deduction. Mistake number 4. Waiting until the very last days of the financial year. Your contribution needs to be received by your super fund, not just sent before the 30th of June. Bank transfers can take a few days to process. Leave yourself plenty of buffer time. Mistake number 5. Contributing money you cannot afford to lock away. Superannuation is generally inaccessible until you reach preservation age and retire. Only use spare money for this strategy. Never money you might need for daily living, emergencies, or upcoming expenses. Let us make this practical. Here is what to actually do. Step 1. Log into MyGov and check the ATO section to see your unused concessional contribution amounts from the last 5 years. Step 2. Check your total superannuation balance to confirm it is under $500,000. Step 3. Work out how much spare money you genuinely have available to contribute this year. Step 4. Contact your super fund and ask about making a personal deductible contribution. Step 5. Submit the notice of intent to claim a deduction before you lodge your tax return. Step 6. Speak with a registered tax professional or a licensed financial advisor before finalizing anything. This strategy involves real numbers specific to your situation, and professional advice matters here. This strategy is not for everyone, and it is important to be upfront about that. If you do not have spare money this year, this is not the right time to use it. If your total super balance is already above $500,000, this rule does not apply to you. If you think you might need extra cash in the near future for a home deposit, medical costs, or family expenses, locking money away in super may not be the right move right now. Superannuation is a long-term commitment. Once the money goes in, it generally stays there until retirement. Never use this strategy with money you are not completely comfortable setting aside for the long term. Here is the bottom line. The carry-forward concessional contributions rule is one of the most powerful and most overlooked tools inside the Australian tax and superannuation system. It rewards people who could not contribute as much in previous years by giving them a genuine second chance to catch up. This is not about getting rich overnight. This is not a secret loophole. It is a legitimate part of the rules that most Australians simply do not know exists. If you have had a few quieter years for super contributions, or if this financial year has brought in more income than usual, this could be worth exploring properly with a professional. If this video helped you discover something you did not know before, please hit the like button. It genuinely helps this channel reach more everyday Australians. Subscribe to Simple Money Aussie with Rafiqi and turn on the notification bell so you never miss a video like this. And drop a comment below with the word catch up if you want a future video that goes even deeper into this strategy. I read every comment, and I will keep making content that helps Australians understand their money better. Before you go, a quick and important reminder. I am not a licensed financial advisor or a registered tax professional. Everything in this video is general information only, and does not constitute personal financial advice. Your situation is unique. Before making any decisions about your superannuation or your tax, please speak with a licensed financial advisor or a qualified tax professional who can assess your specific circumstances. Look after your money. Thanks for watching. I will see you in the next one.